For months, leaders across Europe have been wrestling with the same question. The European Union is sitting on hundreds of billions of dollars worth of frozen Russian assets, but simply handing that money over to Ukraine is not currently considered legally viable. The potential court battles and international repercussions would be immense. Even so, the Union has been determined to find a way for Ukraine to benefit from this frozen wealth. Now, the European Commission believes it has found a path forward. Europe has drawn up a bold and controversial plan for Ukraine that could deal permanent damage to Russia's economic strength. At the same time, this plan is flawed, politically sensitive, and already faces resistance from some of the very countries that would have to implement it. For months, leaders across Europe have been wrestling with the same question. The European Union is sitting on hundreds of billions of dollars worth of frozen Russian assets, but simply handing that money over to Ukraine is not currently considered legally viable. The potential court battles and international repercussions would be immense. Even so, the Union has been determined to find a way for Ukraine to benefit from this frozen wealth. Now, the European Commission believes it has found a path forward. Europe has drawn up a bold and controversial plan for Ukraine that could deal permanent damage to Russia's economic strength. At the same time, this plan is flawed, politically sensitive, and already faces resistance from some of the very countries that would have to implement it. On the 8th of December, the Kyiv Post reported that the European Commission had designed a mechanism to use about 210 billion euros, roughly $244 billion, in frozen Russian assets held across European Union member states to underpin a massive emergency loan for Ukraine. Under this framework, those assets would not be confiscated outright, but they would serve as the foundation for a large loan guaranteed by some of the European Union's biggest and richest economies. France, Germany, and Italy are expected to be among the key guarantors. Crucially, the Commission's proposal distributes guarantee obligations according to each country's gross national income, rather than according to how many Russian assets are held within its borders. The intention is straightforward. Because some European Union governments still oppose directly using the assets to finance Ukraine, the Commission wants the largest and most resilient economies to shoulder most of the financial risk. If the plan passes, the loan package could be released early enough to inject tens of billions of dollars into Ukraine's economy throughout 2026 and 2027, exactly when the country expects to face severe budget pressures due to Vladimir Putin's full-scale invasion. Ukraine would be permitted to spend the money under conditions agreed with the European Union and under European oversight, with the top priority likely being to close the looming budget gap that threatens its capacity to continue defending itself. Politico has provided further detail on how the scheme is supposed to work. According to its reporting, Germany would become the single largest guarantor, reflecting the size and strength of its economy. Berlin alone would stand behind around 52 billion euros, approximately $60.5 billion, almost one-third of the entire loan. The overall package is expected to total about 165 billion euros, a little more than $192 billion. That still leaves several tens of billions of dollars worth of frozen Russian assets untouched. There are two main explanations being discussed for this. One is that the European Commission wants to keep a portion of the assets in reserve so that, in the worst case, something could be returned to Russia rapidly if Putin somehow achieved major gains and forced a settlement that included partial restitution. The other is that the remaining assets would be left frozen but invested over the coming years. Their returns could then be used to reinforce existing Group of 7 loans to Ukraine and potentially support an additional loan in the future if the war drags on and Ukraine again faces a serious financial crisis after the first package is exhausted. Politico also explains how the funds would be allocated. Out of the total, about 115 billion euros, roughly $133.8 billion, has already been earmarked for military and defense spending. This is a huge boost for Ukraine, especially because it now benefits from the United States-backed Prioritized Ukraine Requirements List, known as the PERL program. Under PERL, Ukraine can acquire American weapons via European partners, with European Union states placing and managing the orders. On the 8th of December, the Russian state news agency TASS quoted Ukrainian President Volodymyr Zelensky explaining Ukraine's needs for the PERL program in 2026. He said the program requires $15 billion for that year. He also revealed that this year, Ukraine faced a funding gap of about $1.5 billion, partly filled when the Netherlands contributed $700 million, leaving a shortfall of about $800 million. The new loan from the European Union does not automatically solve this gap for European budgets, but it gives Kyiv options. Ukraine could ask the European Union to allocate $15 billion from the $133.8 billion in defense funds under the loan plan to cover PERL costs. That would still leave close to $119 billion for Ukraine to support its own arms producers and to purchase additional weapons from European allies to sustain its defense against Russia. The rest of the loan is designed to shore up Ukraine's broader public finances. The European Commission envisions these funds being used to cover other parts of the national budget and to stabilize the country's financial system. For ordinary Ukrainians, this would mean that key public services and social programs could continue functioning even as the war grinds on. Politico also draws attention to the remaining 45 billion euros set aside in the plan, which appears to correspond to the portion of Russian assets not directly backing the new loan. These remaining funds, equivalent to roughly $52.3 billion, would be used to repay a series of loans made to Ukraine by the group of 7 countries in 2024. Ukraine would not receive the entire loan as a lump sum. Instead, disbursements would be spread across 6 tranches over the year, according to European Commission presentations cited by Politico. A system of safeguards and audits is supposed to limit opportunities for corruption and misappropriation. In the defense sphere, for example, the Commission would review contracts and spending plans to ensure they comply with European requirements. These safeguards are significant because Ukraine has been hit by corruption scandals recently. In November, anti-corruption bodies exposed a $100 million scheme involving people close to Zelensky working in the energy sector. Those individuals allegedly skimmed funds that were supposed to support the sector at a time when Ukrainian citizens were enduring frequent blackouts caused by Russian missile and drone strikes. The European Commission is determined to prevent anything similar from tainting the frozen assets loan, and the approval procedures highlighted by Politico are meant to provide the necessary checks and balances. Yet the new scheme still comes with important caveats. To begin with, the 3 big economies mentioned earlier will not be guaranteeing the entire loan. Germany, France, and Italy together would cover about 110.4 billion euros, around $128.6 billion. The rest would be spread across the remaining European Union members. Spain, for instance, would be expected to guarantee almost 19 billion euros, roughly $22 billion. Even smaller states such as Latvia and Lithuania would have to commit to guarantees totaling several $100 million each. The European Commission hopes that linking each country's share to its economic size will make the burden more acceptable to states with smaller budgets than the major powers. However, that balance is fragile. If some countries refuse to participate, especially those considered friendly to Russia like Hungary, the shares for the remaining participants could rise. Politico notes that if Hungary opted out, around 1.4 billion euros, about $1.6 billion, would have to be covered by others. To mitigate this risk, the Commission has opened the door for non-European Union countries to join as guarantors if they wish. Norway was widely discussed as a potential partner, but it has since distanced itself from the proposal. Another major obstacle is Belgium. From the start, Belgium has been one of the loudest critics of using frozen Russian assets, and it has good reasons. The British Broadcasting Corporation points out that most of the frozen Russian sovereign assets in the European Union are held at Euroclear, a central securities depository based in Belgium. Under earlier versions of the plan, Belgium would have ended up responsible for most of the guarantee and would have borne the bulk of the legal exposure and the political anger from Moscow. Maxime Prévost, Belgium's deputy prime minister, spoke openly about the risks in early December. He warned that if Russia took Belgium to court over the assets, the country might well lose and would then be unable to repay 200 billion euros, an amount roughly equal to an entire year of the federal budget. In his words, such a scenario would mean bankruptcy for Belgium. Unsurprisingly, Brussels was unwilling to accept that level of danger. German Chancellor Friedrich Merz met Belgian Prime Minister Bart de Wever on the 5th of December to discuss the issue. After their talks, Merz acknowledged that Belgium's concerns about the use of frozen Russian assets were entirely legitimate and had to be addressed in any credible solution. He emphasized that all European states must share the risk fairly. With the new European Commission plan, the economic risk is now spread more widely, so that no single member state is placed in a position where it would struggle to honor its guarantees. This change may be enough to persuade Belgium to lift its objections. If it does, and if the rest of the European Union also signs on, then the 2 biggest early caveats could be resolved. Even then, however, serious legal questions remain, starting with the basic notion of seizing or repurposing frozen Russian state assets. Many politicians and commentators argue that Russia should be compelled to forfeit this wealth as part of the economic penalties for its unprovoked invasion of Ukraine. Morally, this position is simple for many in the West. Legally, it is far more complicated. Sanctions and asset seizures are not the same thing. When a state imposes sanctions, it usually declares that its companies and citizens will no longer trade with specified entities in the targeted country. Even that step is complicated under international law. The Library of the House of Commons in the United Kingdom notes that sanctions adopted outside the framework of the United Nations Security Council occupy a legally ambiguous space. Depending on their design and justification, they may be legitimate exercises of national sovereignty or breaches of international law. That means the sanctions the European Union has already imposed on Russia are themselves somewhat contested. The outright confiscation of frozen Russian assets is even more controversial, but it is not automatically illegal. International law does not categorically forbid confiscation. Instead, it demands that such a move be justified as a proportionate response to a serious violation of international law. Russia's full-scale invasion of Ukraine is one of the clearest such violations in decades. If Ukraine directly held Russia's sovereign assets, the legal and political case for transferring those funds to Kyiv would be much stronger. Ukraine is indisputably the injured state, suffering sustained and massive damage. Under international law, an injured state enjoys broad latitude to respond to a serious breach of the law. As the House of Commons Library explains, an injured state may adopt countermeasures, actions that would normally be unlawful but are temporarily permitted to pressure the offending state to halt its wrongful conduct and make reparation. The problem is that the Russian assets in question are not currently in Ukrainian hands. They are frozen in the European Union, the United States, Japan, and other allied countries. For these states, the legal route to confiscation is more complex, though still potentially viable. Russia's invasion has destabilized the European continent, violated core principles of the United Nations Charter, weaponized energy supplies, and unleashed cyber attacks, sabotage, and disinformation campaigns on European territory. Many legal scholars argue that this pattern of behavior means European states have themselves been injured under international law. That argument is gaining momentum precisely because Russia's actions are ongoing, severe, and openly contemptuous of global norms. This is why more and more policymakers argue that the international community must move from freezing Russian assets to ultimately seizing them. Politically, the rationale seems obvious. Russia has caused more than $1 trillion worth of damage in Ukraine. Justice demands that the aggressor pay, not the victim. Legally, the case is innovative but not entirely new. It builds on doctrines of countermeasures and state responsibility that were developed to address situations where a state refuses to stop its unlawful behavior and refuses to compensate the injured parties. Within this context, the European Union's loan mechanism looks like a cautious step toward a more assertive posture. The European Policy Center describes the proposal as a legally conservative workaround that still relies on an important principle. Even if the underlying assets cannot yet be permanently confiscated, the profits they generate can be redirected to Ukraine as a lawful countermeasure. That approach is only legitimate because the basic claim that Russia owes reparations remains in force. The European Policy Center stresses that countermeasures are not reprisals. They must be reversible and must be lifted once the original breach of the law has been remedied. The European Commission's design meets this requirement. The plan leaves Russia's formal ownership claim intact in theory, but only until Moscow ends its aggression and pays what it owes. If Russia continues to refuse, the political and legal debate will drift toward full confiscation. Several countries, including the United States and Canada, are already drafting legislation to create a clear legal framework for permanent seizure of Russian assets. There is very little precedent for a mechanism on this scale because the underlying crime, a nuclear-armed state attempting to erase a neighboring country by force in modern Europe, is itself almost without precedent. Russia will almost certainly challenge any attempt to repurpose its frozen assets. A legal confrontation is virtually inevitable. Yet uncertainty is not a convincing argument for inaction. It is a sign that the international legal system is being forced to adapt to a crisis it was not originally built to handle. In many ways, this is exactly the kind of situation in which legal innovation becomes necessary. It would be perverse if an aggressor state enjoyed stronger protections than the country it is attacking. If the international community is serious about accountability, Russia's frozen assets will not remain in limbo indefinitely. Sooner or later, they will be directed to where they belong, helping to rebuild the country Russia has tried to destroy. All of this brings us back to the European Commission's plan. Even in its revised form, with Belgium's concerns partly addressed, significant obstacles remain. Some potential participants are clearly lukewarm or openly critical. The European Central Bank has already announced that it will not support the idea of using frozen Russian assets as collateral for a loan to Ukraine. On the 6th of December, the Kiev Post reported that the European Central Bank believes such a loan structure would breach several European Union treaties. Commission President Ursula von der Leyen has acknowledged these concerns but is pressing ahead. She hopes to secure approval using a qualified majority of member states, a procedure that would sidestep outright vetoes and reduce the need for formal backing from the European Central Bank. Still, the legal questions refuse to go away. Further complications arise from the stance of France, a country that is central to making the plan work. On the 8th of December, The Telegraph reported that France has blocked the release of some of the frozen Russian assets it holds, threatening to derail the entire initiative. Paris controls roughly 18 billion euros of Russian funds, nearly $21 billion, and has so far refused to reveal exactly where this money is located or which financial institutions are involved. French officials cite banking confidentiality rules as the reason for withholding these details, echoing European Central Bank concerns about the legal and regulatory sensitivities of the plan. A spokesperson for the European Commission compared this to doctors publicly discussing patients' medical records, arguing that this is highly sensitive market information. These privacy arguments could become a major stumbling block. If they do, France will find itself under intense scrutiny. The French government has repeatedly expressed support for using frozen Russian assets to assist Ukraine, and President Emmanuel Macron has portrayed France as a leader in the Western response to Putin's aggression. Now, however, France risks appearing to obstruct the very plan that could turn those pledges into reality. At a minimum, Macron will be pressed to explain his country's position, and many of his European partners may find banking secrecy an unconvincing justification. Concerns are not limited to Europe. Non-European Union countries that might participate as guarantors or that hold their own frozen Russian assets are also hesitant. As noted earlier, the European Commission's plan invites other asset-holding states to adopt similar mechanisms. Japan, which controls about 25.7 billion euros worth of Russian assets, roughly $30 billion, has already been approached. According to Politico's reporting on the 8th of December, Tokyo has declined to join the European scheme. This may have less to do with legal doubts about the plan itself and more to do with the position of the United States. Washington has been cautious about endorsing the repurposing of Russian sovereign assets, and Japan seems more concerned with preserving its close relationship with the United States than with taking on additional risk to support Ukraine. Only future developments will show whether Japan will maintain this stance. Meanwhile, Russia has reacted in its usual fashion, with public ridicule mixed with veiled threats. On the 4th of December, just days before the latest version of the European Commission plan emerged, Reuters reported comments by Russian Foreign Ministry spokesperson Maria Zakharova. She warned that any illegal actions involving Russian state assets would draw a response and said that preparations were already underway for a package of countermeasures in the event of what she described as theft and seizure of Russian Federation property. In this context, those countermeasures are most likely to be legal and financial moves rather than direct military retaliation. From the perspective of the European Commission and Ukraine, the worrying part is that Russia might be able to assemble a reasonably strong legal case. That would not guarantee victory for Moscow, but it would add yet another layer of complexity to an already delicate process. Despite all these hurdles, the potential benefits for Ukraine are enormous. If we assume that the plan is approved, that all the major European Union members sign on, and that Russian threats fail to derail it, the new loan could be decisive for Ukraine's war effort. Ukraine's economic vulnerabilities have been the subject of increasing scrutiny through the second half of 2025. In September, The Economist highlighted the country's key financial challenges. It noted that Ukraine had managed to achieve modest economic growth that year, in the range of 2 to 2.4%. However, much of that growth came from defense and technology firms whose main focus is the war effort rather than the civilian economy. The more pressing problem is that tax revenues and domestic borrowing are barely sufficient to cover military spending, which now amounts to roughly 2/3 of the national budget. That leaves an entire remaining third of the budget that needs to be financed by external support. Even the most optimistic forecasts, The Economist warned, suggest that Ukraine's budget deficit in 2026 will be in the region of $45 billion, and the final figure may turn out to be even higher. Western commitments by September only covered about 27.4 billion of that shortfall. One Ukrainian official summed up the situation bluntly by saying that there simply is no money and that Europe alone does not have enough resources to restore Ukraine's economy. Al Jazeera has painted a similarly grim picture. It reports that the combination of Ukraine's budget deficit and its public debt is likely to exceed 100% of the country's gross domestic product in 2026. The outlet also stresses that the European Union has not yet managed to secure firm long-term financial commitments from the United States that would significantly reduce these risks. All of this leaves Ukraine in acute need of the very loan the European Commission is proposing. Kyiv will be watching anxiously to see whether a sufficient majority of European Union states are willing to assume the role of guarantors and move the plan forward. France is already showing signs of hesitation, but Macron could still be persuaded if enough political pressure is applied. As the New York Times observed back in November, there does not appear to be a plan B if the frozen Russian assets remain unused. For many, the Commission's latest proposal looks like a last-ditch throw to save Ukraine's finances. If that is the case, it is a throw that cannot be allowed to fall to the ground. There is at least one factor working in Ukraine's favor. Russia's own economy is under severe strain. Western sanctions and Ukraine's increasingly effective strikes against Russian oil infrastructure are tightening the economic noose around Putin's regime. Something fundamental has already broken in Russia's war economy, and Putin is struggling to repair it while the costs of the invasion continue to mount. The conflict may ultimately be decided not only on the battlefield, but also in the realm of fiscal endurance, by which side can sustain its financial reserves the longest. Ukraine's partners have an opportunity to tip that balance decisively. To understand just how close Russia may be to a financial breaking point, viewers are encouraged to watch our in-depth video on the looming collapse of the Russian economy. And remember to subscribe to the Military Show to stay updated on every major development related to Russia's frozen assets and Ukraine's fight for survival.